Dissecting journal entries using example. On 1st April 2025, Anu started a business with $100,000 cash and $50,000 worth of goods. Anu paid $5,000 in cash for office rent on 2nd April 2025. On 5th May 2025, goods worth $10,000 were sold on credit to Ravi. On 15th May 2025, Anu withdrew $3,000 cash from the business for personal use. On 20th May 2025, Anu received $4,000 as advance rent for the next month. Record the journal entry. Starting with the first entry type, that is capital contribution. We now know that Anu started the business with some cash and goods. To record Anu starting the business, we have the following journal entry. There are 3 accounts involved in this transaction. First is the cash account, then goods account, and then the capital account. Cash is an asset. When the business receives cash, its assets increase. According to the rules of accounting, an increase in assets is debited. In other words, cash is coming into the business and it's an asset. So according to the rule, we debit what comes in. Goods are also assets. When the business receives goods, its assets increase. Therefore, the goods account is debited. The total amount invested by the owner represents capital or equity in the business. Capital is a liability or equity account from the business's perspective. An increase in capital is credited. The total capital is the sum of the cash and the value of the goods. Next, we have to record expenses in our journal. In this part, Anu paid rent in cash. So we will record this transaction in the following manner. The accounts involved are rent account and cash account. Rent is an operating expense incurred by the business. According to the rules of accounting, all expenses are debited when incurred. Cash is an asset. When cash is paid out by the business, the cash balance decreases. A decrease in an asset is credited. Our next transaction is a credit sale. Some goods were sold on credit to Ravi. So we will record the journal entry as follows. The accounts involved in this transaction are Ravi's account and the sales account. Since the goods were sold on credit, Ravi becomes a debtor to the business, that is, he owes money to Anu's business. Using the traditional rules for personal accounts, Ravi is the receiver of the goods, so his account is debited. In simpler terms, Ravi becomes a debtor, so his account is debited. Sales represent revenue earned by the business. According to the rules of accounting, revenue increases equity and is recorded as a credit. So, using the traditional rules for nominal accounts, sales are income, which are credited. In other words, sales generate income, so sales account is credited. Our next transaction is drawings. So, we know that Anu has withdrawn the amount from the business for some personal use. It is recorded in the journal as follows. Drawings account will be debited and cash goes out of business, so it's credited to cash account. When the owner withdraws cash or goods from the business for personal use, it is treated as drawings, which is short for withdrawing. Drawings reduce the owner's capital in the business. A reduction in owner's equity is recorded as a debit to the drawings account. Cash, which is an asset, is being taken out of the business, so the business's cash balance decreases. A decrease in an asset is credited. Our final entry is income received in advance. Apparently, Anu has rented out some space, for which a rent has been provided in advance by the renter. This transaction will be recorded as follows. The accounts involved are cash account and rent received in advance account. The business is receiving cash, so its cash asset increases. Naturally, an increase in assets is recorded as a debit. Since the rent received is for the next month, That is, the service of providing the rented space for that period has not yet been rendered, it is not yet earned revenue. It represents a liability for the business. Meaning, it is an obligation to provide the service in the future or potentially refund the money if unable to do so. An increase in liabilities is recorded as a credit. This amount will only be recognized as rent revenue in the next month when it is actually earned. In simpler terms, rent is income, but it is in advance, so it doesn't belong to this period. Until the period it is earned, it remains a liability.